Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And with us today, we're joined with Ben Fraser. Ben is a longtime friend of mine here in the investing space. But Ben, welcome to the podcast.
Yeah, thanks for having me. It's always fun to hang out.
Excellent. Well, before we dive into your deal that we're talking about today, which is Watercolors of Centerton, 376 units in Bentonville, Arkansas, tell us a little bit about you, your journey in multifamily real estate, and where you're at today.
Yeah, well, thanks so much again for having me on. So I'm the Chief Investment Officer at Aspen Funds. I've been here for 5 years. And so we have been investing in multifamily for several years, but we also invest in many other asset classes. So, multifamily is a kind of a core pillar for the types of assets that we look for. So a couple of years ago, we're really heavy into the, Class C, Class B, heavy value add type deals, but really shifted probably a year ago to more development and Class A opportunities. And so the deal we're talking about today is a Class A new development deal purchased straight from a developer in a really hot market. You said, you kind of know the Bentonville area, it's on fire. And so, it was a really fun transaction and a really difficult transaction, but that's a little bit about me and about how we're looking at the world right now.
Awesome. Well, and you already alluded to it. My husband and I, for those people who know me from the Passive Investing Made Simple Masterclass, they know the story. My husband's an avid mountain biker, and who would think that Bentonville, Arkansas is the mountain biking capital of the world? I know, might be blowing some minds here, but anyways, we actually have a bungalow there in Bentonville. We go there often. We love it. Well, awesome. Let's dive into the deals. Watercolors at Centerton, 376 units in Bentonville, Arkansas. You closed early this year.
Yep, 23. Yep.
2023, January, right?
Yep.
Perfect. Okay, so let's back up the timeline a little bit. How did you find this deal?
Yeah, so this is quite a saga, and I'm going to keep it very condensed for time's sake. But we actually started talking with the developer over a year before we ended up closing. So this was long in the making, and definitely took a lot of relationship maneuvering to get this deal, because this was a straight from the developer. And so we love this angle, because a lot of times we find that developers, they're trying to make their spread right on the build cost versus what they can sell it for on a more stabilized deal. And so they are looking at just building and not necessarily optimizing the property. So we were looking at this property, beautiful property in a great area, but the rents were already like 20% below market in the hot market that's growing double digits year over year in rent growth. So, it's from a number standpoint, it makes a lot of sense. This allows us a great deal, but developers, they're also can be a little hard to work with. So, it was, we had the deal, we lost the deal, we had the deal, we were about to go into contract. He verbally agreed to all our terms. Literally, we send the contract to him. It's a couple of days, don't hear anything back. It's a week. We're getting a little nervous. And all of a sudden he comes back and says, I had this private equity firm that flew in from New York on their private jet, and they're offering me, $3 million more. And so I think I'm going to go with them. We're like, what are you talking about? We're talking for over a year on this thing. We verbally agreed. So it was just this back and forth. We finally ended up convincing them to work with us. And this was an off-market deal, and we're kind of building that relationship for a long time. And so we locked it down. And part of the attractive, feature of this deal was it had assumable Fannie Mae debt at 3.49% interest. So, 2 years ago, no one was talking about loan assumptions, right? That was stupid and needless. But as rates started going up, obviously 3.49 was one of the sweeter interest rates. So that, we got under contract, and we had this big loan assumption piece that we had to figure out, and we'll get into that in a minute. But lots of ups and downs. Thankfully, we closed on it, but it was there were definitely moments where I was like, wow, I'm going to lose 7 figures of earnest money on this deal, because things just weren't going to happen. So
Oh my, well, I want to have a discussion about that, but let's kind of like nail down the timeline a little bit. So a
yeah.
year before, a little over a year before you guys are talking to him, when did you guys finally, oh, well, also this whole other group from New York swoops in,
Yeah.
almost sweeps the deal out from underneath you. In relation to January, when was that? And then what locked the deal for you? Like, why did he go with you over that other group?
Yeah. So, I'm a little fuzzy on timeline sometimes, so it's gonna be more general. But yeah, we started talking with them over a year ago. It was in December, I think, of 21, and then we were really close to locking the deal down. It took until about September, but we've been talking about it, and we had all the terms agreed on. We sent them the contract, and at this point, we're um, coming with some hard money day one. No contingencies. That was his thing. He's negotiating hard, right? So he wants $1 million earnest money, no contingencies.
But
And
if he goes
so we're
with
like,
a different group, is your earnest, doesn't he have to return the earnest money?
oh well, this is before we had actually signed the contract, right? So I'm
Yeah,
just saying,
okay.
when we're negotiating, we're like, man, this guy is working a hard deal, but it's a good enough deal, so let's do it. So then we send the contract. We're willing to put the 7 figures down hard, and then we don't hear from him for a week, right? And so we're like, okay, no big deal. He's probably busy. He's always traveling. And then you start to get a little nervous, right? And you try to be optimistic, and then you get the dreaded call of, this group flies in and they're offering me, $3 million more, which, this is a $72 million purchase. So it's, it's still a big number, but relatively it's not, more than a couple percent. But ultimately we had to match the price. That's how we ultimately won it. I wish I could say, we had this, great relationship with his cousin or something. No, I mean, it was a good enough deal where we knew we could stretch at that base. So it was off market. So we already had a good basis on it. And even still, it was a good basis. But yeah, we ended up saying, hey, if we match the terms, we go hard day one, will you sign it tonight, pretty much? And he said yes. So we got him to sign it. And yeah, then the real fun began.
Well, let's talk about the real fun. So how did you structure the contract? What was your timeline for due diligence, closing? Did you have any extensions?
Yeah, so there was a few things that we're looking at this deal. There was a few kind of like big puzzle pieces we had to solve for. So the obvious one is the loan assumption. And because he got the Fannie Mae debt at it wasn't a fully stabilized property at that point. So loan proceeds were a little bit lower. So the LTV, with the assumption was, let's see if I can remember the exact numbers here. It was going to be about, I want to say 60%, 55 to 60%. So it wasn't terrible, but it was lower, right? And so we needed a lot of equity. We needed $28 million of equity. And so we solved it for a few ways by, bringing some pref equity in. And then we raised a lot of common equity, brought a few co-GPs in. But the real big challenge was the loan assumption. So this was my first loan assumption. One of our partners that is a co-GP on this deal has done a few loan assumptions. And so they, were able to help us navigate it. But anything with the government takes a little bit longer than, if you do it otherwise. And so one of the issues we had was we had this money that was hard day one. We were able to negotiate a financing contingency where we get 30 extra days. But we had a feeling that this developer, this seller he wouldn't honor it. I mean, just basically the vibes he was given was, you close by the day that's in the contract, or you have to sue me to get your money back. So we're already in a hard position. And, so we're working with our servicer to do the loan assumption. And thankfully they were incredible and helped us move through all the pieces. But there's a lot of mechanics with that. And so we definitely learned a lot through the loan assumption. And then getting all the pieces for Fannie to agree with the pref equities terms is a whole other piece of this, right? If you use pref equity, that's something you got to be thinking about when you're using any kind of loan assumption, especially with Fannie Freddie type debt. But yeah, it all came together the 11th hour. We literally closed in the last day of the contract.
Well, normally we talk about the due diligence period first, but since we're
Yep.
talking about the loan piece, like walk me through the capital stack. So you have like 55, 60% on the loan assumption.
Yep.
You're raising 28 million in equity. Part of that is pref equity. What slice of the pie was pref equity, and what were the terms on that pref equity?
Yeah, great question. So the slug of pref of the 28 was about 10 million, and then we brought 18 million common equity on top of that. So it brought the total LTV up to about 70%. And the terms on that, they're pretty favorable, I think, because there's a larger slug, and we had some really good debt. Obviously in first position, our blended cost of capital was pretty good. So I think it was a 2% origination, 8% current, and then 1.5 on the back end. I think 1.5 to 2% on the back end. So 12% all in cost of capital for the pref.
Okay, and then on the common equity, what was your return profile on that?
Yeah, I mean, it's a pretty standard split. So we had I think it's a 6 pref and then a 70-30 split, and then an outperformance hurdle over, I want to say 20%. It was go 50-50. So pretty common waterfall for common equity.
Okay, awesome. And then let's talk about the debt piece. When you did the loan assumption there, we said 3.49%. Is that what you ended up settling at for the rate?
Yep.
Okay. And when you do a loan assumption like that, is there any sort of like lockout periods? Do they reset a prepayment period on that debt? Like what happens there?
Yeah, that's a great question. So the cool thing with the loan assumption is you're pretty much assuming the loan as it is when you make the assumption, right? So that he had had it for about 1 year. So there's a 10-year loan. There's 9 years left, another year of interest only. And they had a small assumption fee, but I can't remember exactly what it was. It was like 25 bips or something. It was pretty minimal. And then all other terms remained the same. And so that's one of the cool things with, these assumptions. If you can find these kind of unicorn deals where you get the benefit of wherever they're at without a whole lot of extra fees, resetting of prepayment penalties or anything. So you kind of get wherever you come in at in the time frame is what you get on the loan assumption.
And definitely in today's environment, that could be a great way to enter in on a multifamily property with stabilized debt already in place. Now, where are you on that interest only period? That's kind of the wild card, right?
Yes.
So let's go back to the due diligence period. You signed the deal. How many calendar days did you have to complete your due diligence? And walk us through how that all went.
Yeah. So because we had this loan assumption, and everyone understands that that's going to add just some time to this deal, right? We use that to our advantage. And so we said, hey, this is going to take some time, to close because we have to get approved by Fannie. And, we ultimately had that contingency in the contract that we kind of pushed back on, though we didn't know if it was going to be, a clean exit of the relationship if we didn't hit it, but we still use that to our benefit. And so we had a total of 5 months, actually. So we had 60 days of due diligence, and then we had basically 90 days to close from there. And most of that we used for raising the capital, because that was, a big chunk of equity. And then if you think back, we were raising this equity in Q4 of 2022, and you're talking offline before we hit record that you kind of went quiet and investing in deals in Q4 of last year, and so did everybody else in the market. So
for various reasons, right?
Yeah, there's a lot of reasons, but that's when the market started to tank. Interest rate, are starting to really impact CRE pretty hard. Everyone's getting kind of nervous. Are we going to go into a recession? And so everybody went risk on right as we're about to do the raise for this deal, right? And so this is one of the bigger raises we've done. And the worst timing possible. So, that was definitely a challenge. And then, then the holidays, into that, I say every year, I'm never going to do an offering, before Christmas and in Q4. I don't want to do between Thanksgiving and Christmas is just, very hard to raise money. And every year I end up doing something because a good deal just pops up and you got to do it. Right. But,
Mhm.
um, yeah, it was a rough time.
It's so funny you say that from a personal perspective on my personal holdings. Like, I've bought majority of my properties between Thanksgiving, November and
Interesting.
January. When
Yeah.
you look at, because nobody else is looking, nobody else is shopping
Nobody else is looking.
deals. But
Yeah.
the one that I had to raise money on was hot pokers under the fingernails for sure. So, well, let's talk about the due diligence piece. Did you walk every single unit on the property? Like, were there any
Yeah.
surprises there on physical due diligence?
Yeah. We walked every single unit. I mean, all things considered, the seller was pretty amenable to all of our requests for due diligence. So we did all the normal things, scoping the sewers. We, got inspections on all the kind of key pieces of it. But again, you got to keep in mind, this was a new Class A property. So it's pretty new. It was more just kind of making sure there weren't big things that were missed or things that, a developer would try to hide or skimp on. There's some little things like, hey, these handles on the stairs are already kind of rusting out a little bit, paint those. But ultimately it came back, crystal clear. And were no real issues in due diligence, but I think that's partly just the age of the property.
Awesome. Okay, and then what about the financial due diligence on the property? How did that go?
Yeah. I mean, it's just like anything, you gotta trust but verify. So, building the good thing is one of our partners on the deal actually lives in the area and he works with the property manager that was currently managing the property before we purchased it on a lot of his other properties. So he had some inside scoop and connections to the company that was managing this property even before we purchased it. So that gave us a lot of insight that maybe won't be reflected on the financials of what's the leasing activity like, what's demand like, what's the wait list like, what are you guys seeing? And the nice thing on this deal is it's new, it's in a really good area. So physical vacancy is extremely low. And we had an inside track into the property manager with the financials.
Awesome. And with this being a development deal, 1 year in, right? The previous owner had owned it for 1 year. Where was he on the stabilization? Like, was it 75% occupied, 85, 95? Like, where were you guys on the stabilization of the asset?
Yeah, and so not to get too complicated into the deal structure, but there's three phases to the property. So we only purchased the first two phases. We're about to purchase the third phase, which will be delivered in May or June of this year. So that added more complication to the contract, right? Because you're thinking about how do you establish basis for all three phases. We have, different financing things in place for different phases. So all that to say, the first two phases, we're running right now at 97% occupancy. So it's a, very, very strong occupancy. That is 232 units are the first two phases. 144 is the third phase. So the 232 is very stabilized. And we've already been pushing rent since we've acquired it, just a few months ago. And we're adding some other new amenities. We can talk about, strategies for Class A. I know you guys do that a lot at Passive Investing, on how you kind of, create some alpha on Class A. But, that made it pretty easy from the financing standpoint. And then the phase 3 is going to be a lease up, but it's all going to be commingled into the same offering. So you kind of get a uh, blended stabilization plus lease up alpha.
Awesome. All right, let's talk about this earnest money piece. So you guys put down 7 figures on the earnest money. Did Aspen Funds front that earnest money? Did you guys bring in investor money? Like, how did that go?
Yeah, we didn't bring any investor money in. So on this deal, we have one other kind of lead co-GP with us. So, we're lead alongside another firm that we're kind of the two running the project. And then we have a couple other capital raisers that are helping us out and doing some asset management, other things. But the earnest money, yeah, it came straight from our pockets, and, plunked it down. Just, close your eyes and hit the send button pretty much.
And hope that the execution of that contract goes to timeline, right? Especially when you have
Yes,
the other end who is chomping at the bit. Well,
exactly.
I think one thing that's really interesting for people listening to the show, because we talk about multifamily units of all sizes, right? 5 units all the way up to like 500 units. So let's talk about the partnership side, and please share like what you're comfortable with. Like how
Yeah.
did you guys organize this? And did those other partners come in? Did you see the deal and then go, oh, we need more partners? Like, how did you organize that? What are the, if you can get down to the splits, because I think people are really interested, like, how do people take down these large, complicated deals?
100%. And yeah, I'll share as much as I can. So, I mean, fast forward just a few years ago, I think a lot of people, they see and hear the big numbers and the deals you guys are doing, and, some of the deals we're doing where these, big properties and they're big numbers. It's like, man, it'd be crazy to get to that someday. Literally like 2 years ago, some of the first multifamily deals I was doing was like, 48 units, and they're class C, and it's, 60,000 a door versus now 200 a door or whatever on this deal. And so that's the cool thing, is it's my approach has always been, if you can find good deals, then you can build good structures around them, both from a general partnership side and then for your investors. And so it's always chicken and egg problem, right? You always either have investors want to deploy capital and you don't have enough deals, or you have way too many deals or too big of a deal and not enough capital. And in this case, it was kind of like you want to win the deal, but you kind of don't want to win the deal because you know how hard you're going to have to work if you actually get it, right? And so, there's some times when we're negotiating with the seller and he's pushing back, and I'm like, part of me was like, screw it, like I don't want to do this anymore. But then you go back and you look at like, but this is a crazy deal, right? And this is a flagship deal, so we got to make it work. And so that's just kind of that roller coaster ride emotionally, right? And then I think once we had the deal under contract and we were able to negotiate a longer close period, right, with the due diligence and then closing because of the assumption, we knew we had enough time to really put all the right pieces together. And so then it was really an evaluation of what's going to be the best capital structure for this, right? We could probably support a little bit of pref equity because, we've got really good first position debt and low leverage. So we can kind of bring that up. So that helps, shorten and shrink the common equity piece. And then it was just finding, the right partner. So part of the deal with the loan assumption is not only is the, is Fannie going to want to make sure you have the balance sheets to qualify, right, for a big deal like this, which, it was a stretch, but it wasn't a huge issue there. The bigger piece was the experience, right? So they want to make sure, do you have other assets in this area? Do you have other class A assets that you have acquired? Have you done any other loan assumptions, right? And so we ended up bringing on a partner that we've invested with as LPs for a period of time, to, come on the deal, to help with the capital and help with structuring, but also to help with the experience and having done a loan assumption before. So that was a key piece of what we needed in our team. And then, yeah, just kind of filling out the common equity piece was obviously important as well.
Awesome. All right. So I have a couple questions for you as we wrap up, and I'll ask them both at the same time. What did you think was going to be easy on this deal that actually turned out to be a little bit more difficult or challenging? And then what did you think was going to be actually really challenging that you're like, hey man, that actually went smoother than I thought it was going to?
Oh man, those are really good questions. It's funny because it's like going back to put myself in the middle of when we're doing this closing. It's almost like PTSD of like so much stress, right? During Christmas and closing, all this kind of stuff. It was just so much. But I think it was like looking back and, now a few months out from closing, it's like, oh yeah, we did that. It was no big deal. We just made it happen, right? If you kind of, when you're in the middle of it, I think it can feel overwhelming. It can feel like, man, we're not going to make this happen. We're going to lose 7 figures, blah, 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 blah. But you just got to move past that, right? You gotta remain optimistic. You got to keep pushing forward. You got to do everything you can to make it happen. And surprisingly, things will happen, right? And if you get the right people on board and the right team, and you get everyone working toward the same goal, it's pretty incredible what can happen. So I think, to answer, you know, the second question first, I there was, we're closing on January 5th. We're trying to raise all this equity. That's, was a huge challenge for most of Q4. And then, we got this loan assumption, and, the folks over at Fannie, they're taking the holidays off. They're not working extra. Right. And so I'm like, there's no way it's going to happen. And, so that's the pretty stressful part. But then you kind of fast forward to the day of closing, like the last day in the contract, we made it happen, and everyone came together, and it was like this just, flood of relief and honestly shock. I was like, I cannot believe this just happened, And so I think you kind of sometimes underestimate what you can do if you got the right people on board. And I think the things that, I thought would be easy versus, it ended up being harder. Honestly, I think it was the common equity raise, because I think for so long, multifamily has been so easy to raise for, right? When rates have been low and you got all these great fundamentals, these great tailwinds of rent growth, and, late 2021, early 2022, that was like, you throw a multifamily deal up there and it's subscribed in 24 hours. And we had that experience on some other deals that we had done earlier in that year. So I'm going in like, okay, we've done the hard part. We got the loan assumption in place. We got the team in place. We're doing due diligence. We got the earnest money. We got the pref equity lined up. Now it's just common equity. This is the final piece. It's going to be easy. And it was just like, it was pulling teeth because the markets had totally turned. And so sentiment had just really shifted. And it was really, people, when they get in a mode of fear of what's going to happen, are we going to go into recession? Am I going to lose money? What's going to happen with interest rates? People get indecisive, right? That's just human nature. And so I think that was a little bit surprising, and definitely created another challenge. But again, just meet it, do your best, push forward, and solve for it and get it done. That's as simple as it is.
Well, Ben, thank you so much for sharing your knowledge and expertise with us here today. If people want to find more, connect with you or find out more about you, how can they do so?
Yeah. We have a podcast that we run called the Invest Like a Billionaire podcast. You've been a guest on it, which is really fun. And then our private equity firm, which do the syndications of funds, is aspenfunds.us. And I can learn more about some of the deals we're doing.
Excellent. Well, Ben, again, thank you for joining us here today. And we look forward about hearing about future deals.
Yes. Thanks so much for having me.